In this video, we will outline some possible market scenarios based on where the S&P 500 and futures closed on Friday, May 11th. We'll take a look at how the CCM market models closed last week. We'll look at some important Demark levels to watch. We'll look at the formation of a possible head and shoulders pattern in the S&P 500 and some targets. We put targets in quotes because we really don't like the fact that targets insinuate that you know where the market's going. They're possible targets. We'll look closely at a Demarked chart, and we'll finish with valuations relative to PEs and highs and lows in 2011 and where they sit today. You can pause this if you want to take a closer look at it. This is basically the numbers that we looked at last week. These are our market models. This is a composite of these three models. These figures here are where these models have a tendency to bottom in a relatively tame bull market pullback, a pullback that you would want to leave alone and not worry too much about. So you can see this is the week of May 4th, Friday the 4th. This is last Friday, May 11th. We did have some deterioration last week, and we'll show you a traditional chart as well as some Demarked charts that say we're still at a point where we have very little margin for error. There is still some hope for a bullish resolution relative to these numbers. Our risk model on Friday closed at 50, and that's about as close to a fence-sitting market as you can get. That means 50% of the parameters or questions in that model are giving us bullish responses, and 50% of them are giving us bearish responses. Before we cover these Demark levels, it is important to note that Demark indicators are proprietary indicators and tools from Market Studies, LLC. What we've got here, we're looking at important Demark levels from Tom Demark's indicators based upon the S&P 500 futures. Why are we using the futures? Because right now it looks like the futures are leading the S&P 500, and if the futures hang in there, the market will probably hang in there, and if the futures break some of these levels here, the S&P 500 will most likely do the same. Last week we broke Demark TDSD support level at 1358, which leans towards additional weakness. Where the futures closed on Friday was at 1350, and these next two figures show you the fence-sitting nature of things from a Demark perspective, which aligns with our risk model. And you'll see in the next chart it also aligns with some possible head and shoulders patterns in a traditional S&P 500 chart. We closed at 1350 futures on Friday. There's a Demark trend line right at 1350, and he's also got a propulsion indicator yellow line at 1350, which we'll show you on a chart in a moment. And all of this says is there's some potential support from a Demark perspective right around where we close. So if the futures were strong on Sunday night and carried into Monday, that could be a good thing for the markets. Conversely, if 1350 doesn't hold, from a Demark perspective, some of the downside targets might be somewhere in the 1292 range or 1281. You can also make a case from a Demark perspective, we haven't shown it, that there's some support around 1340 are some levels to watch on the downside. If you want to come back and look at this chart relative to the Demark chart that we're going to show you in a little bit where these figures came from, this just tells you how to find things. Red triangles will tell you where this level came from on the Demark chart. This is a traditional daily chart of the S&P 500. 1415 would be a number which is derived from this area here that would somewhat break this downtrend. If we were to move above 1415, the bulls would have some hope of going on to make a higher high. So that's kind of a bullish demarcation line to keep in mind. What we're looking at here, these pink lines show you two different ways that you could look at a head and shoulders topping pattern on the S&P 500. Let's look at the dotted line first. This would be your left shoulder here. This would be the head, and this would be the right shoulder. Same thing here with the solid line. It just comes down a little further. Here's a shoulder, a head, and a shoulder. The way you do targets on head and shoulders patterns is if you break these lines, either the dotted line or the solid line, you would anticipate that you would fall the same distance as drawing a line from the peak to the shoulder line or the peak to the shoulder line. So that's this green line and this blue line. So if you just take those and copy them down to where you break this shoulder level, in the case of the green line, it goes here. In the case of the blue line here, it gives you somewhat of a head and shoulders downside target. And sometimes these things work extremely well. It worked extremely well recently for silver when it declined and found a bottom in late 2011. I believe it almost nailed it to the point on the way down. This is fence sitting too. It's showing you here that we're trying to hold in. The market held here. This acted as resistance here, support here. It's trying to act as support again. If it breaks, then maybe one of your head and shoulders targets is somewhere in the neighborhood of 1306. And if it were this line that was actually the head and shoulders pattern, it would take you down somewhere around 1280 to 1275, which is also right in the neighborhood of this 200-day moving average that you can see is starting to flatten out, which is also a fence-sitting type situation. This is either going to move back up if we can regain some momentum with price, or it's going to roll over potentially. And you can see the 50-day here in blue has already started to roll over in a bearish manner. So all things being equal, this isn't good. This is a lower high relative to this, and this is a lower low relative to this. So this is the definition of a basic downtrend. So what we'd be looking for is, just like the Demark levels and just like our risk model, it's saying that there's not much margin for error here. 1350, if we break below this, we could move relatively quickly down to, let's say, 1306 or 1280-ish. And these might potentially be good levels to look at buying or establishing new positions. If we can't hold 1306 and or 1280, that would probably be a bad sign in terms of this pullback being more substantial and maybe even more of an important top. But right now, based upon the way we came off the lows in 2011, you still have to give the bulls the benefit of the doubt. It's possible that we could reverse here next week and go up. If not, we'd be looking at this level and this level. Okay, here we're looking at a daily Demarked chart of the E-mini S&P 500 futures. Again, Demark indicators come from Market Studies, LLC. What we're looking at here, and we'll go through it in the same order that we did in the table when we talked about Demark levels earlier in the video. This line here is the 1358, or the red dotted line, where we had broken support, and you can see it tried to act as support in this area here and here. Then we broke through it, and you can see since then, last week on Friday, Thursday, Wednesday, Tuesday, Monday, we've stayed right around that level. The fact that this has become somewhat of a solid looking line means that mathematically with Demark, this line has been broken and violated, and the bias, at least from a probabilistic standpoint, is down. Now let's look at some other things over here. If we look at the TD line, which is here, these are Demarked trend lines. This solid line you can see is about where we closed on Friday. So that's your 1350 TD trend line that was shown in that table. And as far as targets go, this is a potential downside target, especially if these levels give way. And this is right around 1291, which I believe was shown as 1292. It was rounded up in the table as TD target 1. Right here, this is another potential downside target. This yellow line here was shown in the table as TD prop for TD propulsion. It's the yellow line, and what this is it basically says as long as the market stays above this line, the momentum really hasn't accelerated to the downside, but once you go below this line, it has a tendency, the bias tends to shift, and this will become somewhat of a magnet. And this level here is right around 12 1280, 1281, which was also shown in the table. So if you look at the Demark counts, you can see up here we had a 9 and a 13 and a down arrow right about where we peaked. And we're on a 7 count now as far as the combo goes. So what that tells you is you can get potential reversals when you hit a 9, and the second combination would be a 9 and a 13. So what that says is if we had a down day on Monday and a down day on Tuesday, it's possible that we could get a reversal soon thereafter. It's also possible that since this support level was broken, that we're going to go all the way to a 913 count like this did up here. So we just have to keep an open mind using both your traditional charts, our models, and the Demarked charts for next week. Now we're just taking a broad look at valuations based upon PE ratios. We track about 69 blue chip stocks like IBM, Intel, Exxon, etc. This just shows you out of those 69 stocks, the median PE currently is a little over 15. The average PE for those 69 dividend payers is around 17. And what it tells us is we're closer to the high level of PE ratios in 2011 than we are near the low end. And that says from a valuation perspective, there's some downside risk in this market. To get from here to here, you'd have to fall 21% in price if earnings stayed constant, and from here to here, you'd have to fall 27% in price if earnings stayed constant. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.